Okay, it's 11 o'clock. We should get going. So lots to get through this morning. So as we've flagged already, we're going to run probably slightly past 12. So please do stick with us. First off, some news from me. Then Andrew McHattie is going to look at what happened over the course of March. And then I'll be talking to Denis Jackson and Foll from Law Debenture. So, news first. Three things I pulled out, although as it's been happening over quite a lot over the last few weeks. I could have pulled out more, actually. There's quite a lot going on. But the first one, quite a big one. So AVI Japan Opportunities made an approach towards Fidelity Japan. And as we know, sort of hostile, I don't know, yeah, I think it is sort of hostile approaches are quite rare in the sector. They've basically been frustrated that they've been talking to Fidelity Japan and they haven't been listening. So they've gone public with what they do, and which is kind of what they do in real life in investing in Japan anyway. So you can see the chart for Fidelity Japan there. We talked about this last week, and I flagged how bad their results have been, and you can see just on the 5-year chart how bad the performance has been too, and how wide the discount's been. Currently 7.8, but that's currently in response to what happened with AVI. And the contrast with AVI Japan Opportunities chart is quite stark in that obviously this one has been performing quite well and the discount's been quite tight. But the discount's slightly widened yesterday, and obviously that's because of everything that's been going on, and Andrew's going to talk about that in a bit more later on. So if we look at the state of play, AVI Japan Opportunity is a little bit bigger and would dearly love to be bigger. So one of the things that the performance of all these things is quite lumpy. Nippon Active Value got going and very quickly got a couple of results that boosted its performance, and it was able to absorb a couple of other trusts that had AVI Japan Opportunity. It had been sort of reversed, then AVI Japan Opportunity probably would have done that. So they're slightly lagging. I do think they deserve to be bigger. And Fidelity Japan and maybe Bailey Gifford Japan are the obvious targets for it. These are the return figures, and you can see the stark contrast there in terms of what it's been delivering. And particularly recently, over sort of 1 and 3 years. 5-year numbers, remember, are a bit weird at the moment because of they sort of go straight back to COVID. And then just sort of recap from last week. So Fidelity Japan underperformed its benchmark over 2024 by quite a lot. Had to buy back a lot of stock. The manager's retiring, so that sort of unnerves people anyway. But the board wanted the managers to have a chance to get through all the way through the into a cycle, and so they said, we will give you an exit, but not until 2028. And I made the point last week that other growth managers like JP Morgan Japanese are actually doing quite well now. So maybe this is just about stock selection and not about the value versus growth debate. What happened on yesterday? AVI has made a merger approach. It's approaching in sort of normal kind of Section 110 merger. So we've seen lots of these recently. I've talked about lots of them already. This one will have a cash exit for shareholders up to 25%. And importantly, because we remembered that the exit was in 2028 for FJV, if you went down this route and you didn't want to hold it at all, you could get out everything in October when AJOT has its annual redemption mechanism. Crucially, the biggest shareholders on side, they would quite like to see this deal go through. Obviously, they're a discount player, so whether they hold on or not remains to be seen. But nevertheless, we'd still expect the fund to end up being a lot bigger than it is now, which is good. It's a big, more liquid fund, big tick in the box. And that also ought to bring down the ongoing charges ratios too, so that they're more in line. And then there was an obvious uplift in terms of discounts when they made that announcement, and then obviously everything got derailed yesterday. But we'd expect that kind of gap to re-emerge if nothing happens. So Fidelity Japan responded this morning. It said yes, we did get an approach in August and we rejected it. That's unfortunate for shareholders, because had they done it and you got the whole thing done by early October, which maybe that's slightly ambitious, but it was easier to look up 6 months numbers than try and do something, say, in November. And it's quite a big difference in terms of what you would have had in AJOT rather than FJV. They also say, well, we've delivered substantial outperformance in the past, so stick with us and that might happen again. But I would point out that its long-term numbers, the 10-year numbers, are the lowest of the peer group, so I don't think that's a defence, and I don't think it's something that they can stick to. They also say that the obvious thing, that it's quite a different style, because you're going from growth stocks to value opportunities, but AJOT isn't investing in value stocks, it's investing in decent quality companies that are lowly valued, and that's not quite the same thing. And so I don't think you're necessarily giving up the kind of growth of the Japanese economy in there. And also, although we're talking about cycles here, AJOT doesn't see that there is a cycle that's going to end very soon. This is a sort of secular trend in terms of improving corporate governance. And that could run for many years yet. And if the story ran out, I'm sure they'd be thinking of saying differently. But at the moment, they say there's quite a long pathway for this. And then, yeah, we talked about the tender offers already. So that's the end of that one. I do think this is not the end of the story. Fidelity Japan is going to have to do something, and I expect that AVI are going to come out and actually make a formal proposal. That's what I'd like them to see anyway. So, if VH Global Energy Infrastructure next has been a bit of a disaster in terms of the share price. It's not uncommon in the sector. The discount's enormous now, 45. The yield's about 10. That's not the highest, as we'll see in a second. And if you look at that chart there, where it's there at the bottom. It's one of the widest discounts, but not one of the highest yields. That's not the sort of way that they run. They're sort of slightly trying to drive some NAV growth as well as income. So it's a total return type objective. The ongoing charges ratio is relatively high. That counts against it. And the market cap isn't very big, but obviously that's slightly reflecting that enormous discount. And in terms of the performance numbers, it's a bit too early to tell. So this was only launched in 2021, and it's only just getting going. But obviously the NAV hasn't been spectacular over that period. But then neither has everything else. So results that were announced yesterday, the NAV fell 6.5%, the share price fell 7.4%. The dividend wasn't quite covered. So all of these things you'd think slightly worrying. And the discount was already wide and has widened since. And they were doing a buyback, but they'd run out of room on that. The plus point was that the gearing was relatively low. So they could do something with that in future. The board has obviously been concerned about what's been going on with the discount, and it's been talking to major shareholders. So they kind of flagged that they were doing this for a while. The feedback was mixed. So some people, I think probably along the lines of, this hasn't been going very long, you seem to be doing okay underlying, let's keep it going. And others more like, well, I've seen this thing dive, I do want my cash back now, or at least some effort buying back stock to drive the discount down. So the board is evaluating alternatives to what it can do to try and then address that. And the wording is ambiguous, but it's sort of inviting approaches, I think, exploring all options. And I do think that sort of puts it in play. The next continuation vote isn't until May 2026, so they're obviously trying to preempt that with some kind of positive development in terms of maybe selling assets to buy back stock or tie up with somebody else. We'll have to wait and see, but they're obviously trying to preempt that. In terms of what they've got, it's a very globally diversified portfolio, and it's got exposure to Brazil, which nobody else has. It's got a big exposure to the US, but that's in one asset that we'll just see in a minute. And that is unique in the sector. There's nobody else that has quite that kind of geographic diversification. And then in terms of what sorts of assets they're investing in, that's pretty diversified too, and again unusually diversified. And the big asset is that one in the US, the terminal storage one, which sits on the border with the US and Mexico, and is importing Mexican oil, refining that, and then selling it on. That was a worry for some people. It was a worry for me, but actually we had a conversation after the previous sort of announcement they had made on this, and they are adamant that tariffs are not going to have an effect, and the full kind of statement is there. You can read it. Basically, it's the sort of argument is that there's nowhere else for this oil to go. It has to go this way. So even with the tariffs, the thing will still keep going, and this is revenue based on the usage of the storage terminals rather than any kind of profitability on the oil. So that does kind of stack up, but nevertheless, I suppose that's unnerved some people. I think that the diversification element of this means that it's not a bite-sized chunk for anybody. I don't really see that a bidder's going to come along for the whole portfolio, but that doesn't mean that people won't be interested in bits of it, and doesn't mean they can't sell off some assets to fund buybacks. It's very different because it's got no exposure to subsidies at all. All of the income, though, is quite predictable because they sell power forward to reduce the impact of power price volatility, so they've got quite long-term visibility on income. And they've got a lot of the portfolio construction stage assets. That will fall quite sharply over the coming year because there's lots of stuff that is almost finished. That's sure to provide some NAV uplifts, and it will definitely improve the dividend coverage. I do think that dividend cover thing is not going to be a problem going forward. So all of this is sort of saying I can't see that somebody's going to bid for it. I do think that the underlying portfolio is improving in quality and doing okay. And I kind of see that this is a sort of self-help thing rather than somebody coming along from outside, but that doesn't mean that we'd necessarily rule it out. European assets, I just wanted to focus on this one because this one's been a disaster for a long time, and you can see that on the chart there. And you can also see that it's a reasonable size, but it's not very big in the context of the European sector, and the performance has been pretty dreadful for a long time, and the results that it published yesterday were poor again, and the long-term numbers are really dreadful. I mean, you look at the 10-year figures and how far they are behind the benchmark. That's enormous. It pays out a dividend of 6% of NAV. Obviously, if the NAV is going down, all you're doing is cannibalising the capital of the fund, so that's not good news. And because the NAV is going down, the dividend is going down, so that's disappointing if you're an income investor too. It's not buying back stock, and this kind of brings us back to that debate we had about Oakley and share buybacks versus dividends last week. So should they just cancel this and buy back stock instead? But the discount isn't enormously wide, only about 10%, so that's not really the problem here. The problem is the underlying performance. And the board is recognising this, and there's quite sort of punchy language here. They're talking about disappointing stock selection. They've made some changes. The fee was cut in January last year. The management was changed in May 2024. We're monitoring the impact of that, says the board. I think there hasn't been an improvement so far that is worth latching on to. So I do kind of think that this is now a big target. It's a really obvious thing to get taken out. And the question is, who could do it? If you wanted to keep the yield and stay in Europe, then the obvious option is to go for the JP Morgan European Growth and Income. But obviously, if you did that, you'd lose the small cap exposure. If you wanted to keep the small cap exposure, I think the best opportunity would be to do some kind of deal with Montanaro European. It's got that new interval structure again that we talked about last week, which should help control the discount, but you would lose the yield. So the question is, do you want yield or do you want small cap growth exposure? The obvious thing you could do is for a joint bid by two of these companies, maybe these two companies, and people just choose where they want to roll over to. But I don't think this thing should continue as it is. I think it's failed and it's time to go. So that is enough from me. Let's now talk to Andrew.
Great, thank you very much, James. There's certainly no shortage of corporate activity for you to talk about. And of course, it's been a very lively and exciting month in the markets. I mean, I think that's a charitable way of putting it. We could probably do with a lot less of that excitement. It was already a dramatic month, actually, with declining markets before Trump's tariff announcement, before the economic vandalism really got going. Actually, just on that topic, I mean, many years ago, I studied economics and remember vividly that economists struggled to agree on anything. But the one thing they did agree on is that tariffs hurt everybody in the end. Yeah, and that free trade actually secures the best allocation of resources. But there we are. That's a topic we could go on about for a long time. So let's have a look at the market and what's actually happened. I think it's quite encouraging, actually, that even against this very difficult economic background and very difficult market background, there were quite a lot of good rises in the sector. And these are principally actually because of corporate action. So we've got quite a few double-digit gains here. You can see there's a lot of REITs on the list and also the battery storage, which I talked about last month. And the overriding theme here, undoubtedly, is the corporate action. So Care REIT attracted a bid that I thought was actually quite a good bid at about a 9% discount to NAV. The news finally came through for Harmony Energy, where we had competing bids for the assets, which was really good news, not just for shareholders in Harmony Energy, which had a big uplift, but also for the other two battery storage trusts, which was anticipated really because they were so much out of favour in trading on these mammoth discounts. And then we've seen a lot of action actually both realised and forthcoming, I think, in the REIT sector. So Warehouse REIT has finally said it is minded to accept the latest of a series of bids that have come in from Blackstone Europe. Life Science REIT has said it's entering a strategic review. Supermarket Income REIT has basically left the sector now by internalising its management. Urban Logistics REIT wants to do the same thing, but that's now being attacked by Achilles, so we'll see what happens. And a little further down there, Premier Might and Global Renewables is also intending to wind down. So there's a great deal of corporate action going on. I think we can just expect that to continue. But it is delivering actually quite good gains for many shareholders. So I think there's a lot to be said to focusing on this and to making sure that you do stay abreast of the news. Because I think if you can skew your portfolio a little bit without being overly speculative, skew it to some of these interesting situations, you can actually do very well. And I'm delighted to see such a good outcome for Harmony Energy. So that's the risers, really. The fallers, I think, possibly more interesting this month. And certainly there have been quite a number of sharp falls, exactly as we would expect in these market conditions. The investment trust sector has not managed to resist these market falls. I mean, it's really fallen very much in line with world market indices. So there hasn't been very much in the way of protection. And amongst this list here, there's a lot of big names, a lot of well-known names. The overriding theme, again, there's one very clear theme, which is the exposure to the US. Of course, you've been very well served by having big US exposure over the last few years. And now that's coming back to bite a little bit. I think all of these ones here I've highlighted in red are largely exposed to the US. That's where their portfolios are. And the US is clearly, it was already in a corrective phase before this latest down leg. It's possible this might turn into a fully fledged bear market, but we'll have to wait and see. Of course, Vietnam holding also at the top there has been very much impacted by the tariffs. And I think if you want to read a little bit more about the tariffs, actually, there's a really good article on the Economist website, which I think is free for everyone to read. It's a really excoriating rejection of this tariff policy, but that's obviously impacting Vietnam quite a lot. And we've seen that Vietnamese specialist trusts all come out with statements actually about the impact of tariffs. So anyway, it's a bit of a grim picture that we're looking at. But I think, there's some interesting things to look at in the market. Maybe instead of talking about these really obvious themes, I'll talk about valuations and what shifted in the market. Because actually, when you do get these really volatile periods of market turbulence, they often throw up really interesting opportunities. And of course, at the present time, with investment trusts generally being quite lowly rated and on an average sector discount of 16.3%, there are quite a lot of good discount opportunities available. And one way of looking at those is to look at Z scores, which place the current discounts into context against their 12-month averages. So I've had a look at those and come up, I think, with some interesting trusts that look expensive or cheap at the current point. But just to put that into context, I'd just like to reprise a chart actually that I showed you a month ago, which was a 6-month chart showing the European markets in blue against the US markets in yellow here. And you can see there was this inflection point around the start of the year actually, where I think investors were already switching out of the US and taking profits on some of their technology holdings in particular, and they were switching some of that money into Europe. And I think there was quite a strong argument actually that in particular with this massive increase in defense spending that we're seeing in Europe, that's potentially quite a big fiscal boost. And so I think there has been actually some switching of positions and manipulating of portfolios as investors come back into Europe. And we can see that in some of the discounts. So if we just flick on now to the relatively expensive part of the market, and these are some of the trusts I think where the discounts have been narrowing, there's an obvious theme here with those top 4 all being European equity trusts, where the discounts have all come into single digits from double digits. And James was just talking about Montanari European, which has obviously had a corporate maneuver to try and narrow that discount. But we've seen this happening anyway across the sector. And I think that's very helpful. It's been good news if you've had these trusts. But also, I think it removes part of this problem, this argument that actually all of the discounts are too wide at the present time. In my experience, that's not true. I mean, I think many of the equity discounts are perfectly reasonable. And if these are, high single-digit discounts, that's okay with me. But those have all narrowed, I think, just indicating that investors are genuinely shifting some assets back into Europe now, having ignored it for some time. There's 2 more at the bottom there that I think are interesting that stood out to me. One slightly curious one, I think, is Invesco Select Global Equity Income, where the discounts really come in actually from a 12-month average of 9.3% to just 0.2%. And I'm not sure why that is. I mean, it does have a 4% holding in Rolls-Royce, and there is quite a lot of interest in defence stocks at this time. And that could be attracting investors. But it's not unique in that, and I'm not sure that's really the reason. I think the other one, Temple Bar, is maybe a bit more obvious, where the discount has halved from 6.6 to 3.2. And I think that's really because there's been a resurgence of interest in value investing, and Temple Bar is certainly one of the trusts that really focuses on that. And I think as investors have backed away from their risk-on positions and backed away from growth, so they're having another look at value investment and seeing that that's actually probably a better place to be at the moment. So that's why Temple Bar, I think, has gone up. So those, I think, are the relatively expensive ones. Let's move on to the cheap ones. And I think there's 3 groupings here. The top group is still private equity, which we've been talking about for such a long time as being an interesting sector on a big discount. And, you'll remember that the board of Pantheon International was very widely feted by the industry last year when they announced their, very big buyback program to try to deal with the discount. And at the time, it seemed to have quite an impact, actually, and that was considered a really excellent maneuver by the board. But I think you'd have to say that discount's just come back out again, and it hasn't really worked in a longer term perspective. So the discount there has come back out to 43%, which is 8 points wider than its 12-month discount. Similar thing, actually, even wider for Apex Global Alpha. And generally, there is quite a lot of value about in the private equity sector still. I was interested this week to see that ICG Enterprise Trust actually sold a group of assets, a portfolio of assets, at a discount in the secondary market. I think the discount was about 5.5%, so it was quite small. And that compares with a 35% discount on its share price. So there is still this big disconnect, actually, between what you're seeing in the secondary market for private equity assets and then what we're seeing in the public investment trust market, where the discounts are much, much wider. So that opportunity still remains, even though we've been talking about it for a long time. The next group, I think, two trusts that were very highly valued and have probably just come off a bit. Odyssean actually has come back to a discount, having been on a premium, and I think maybe that's because its performance has softened a little bit. The other one I think is really interesting, JP Morgan Global Growth and Income, very much a flag carrier for the investment trust mergers. You know, it's taken in maybe 3 or 4 different trusts now. It's been growing inside. It's been very popular, often on buy lists, often at the top of the list of shares that private investors have been buying through the platforms. And it's had an average premium over the last 12 months, which has been very useful for it in conducting these mergers. But it has fallen to a discount now. And to me, I think that's completely justified, because this is a trust that pays part of its dividend out of capital, and that's enabled it to actually skew its portfolio away from some of those value-oriented holdings that do pay high dividends, and it's had more of a growth bias to it, which of course has been helpful over the last couple of years, and that's why it's done well, that's why it's been attractive to people. But now I think that's maybe turning from a tailwind to a headwind. So, you know, it'd be interesting to watch that one. I'm not sure it's going to stay in favour quite as much as it has. The two I'm going to focus on at the bottom, and I think these probably span the risk spectrum quite well. So you have Augmentum FinTech very much in the growth capital bucket. It's fallen to a very big discount now, over 50%, which is against its 12-month average of 38, which is quite wide anyway. But I think this again reflects this massive risk-off position that investors are now shifting to. They're nervous about markets. They're not sure that IPOs are going to take place. They're not really in favour of unquoted investments at the moment. So that's all hurting this trust. And then at the other end of the spectrum, you've got international public partnerships, big, fairly conservative infrastructure trust, again, trading on a wide discount now of 24.8% against a 12-month average of 18. So let's just have a quick look at those two. I'll just call up the charts. So Augmentum FinTech, first of all, you can see here with the green line, its NAV has actually been quite steady, quite decent. Really not bad NAV performance at all. But the share price has been coming off, and hence the discounts widened out. I'm not going to say too much about it, but I just wanted to put its objective up on the slide here, because the key point here is that although it's investing in these small early stage fintech companies, where I think the UK really does have an advantage, by the way, but it's investing in companies that are predominantly in the UK and Europe. So it really doesn't have US exposure. So I don't think this should be impacted by tariffs. You know, financial services are excluded anyway at the present time. But I don't think that's really why it's come down. I think it's just part of this general sell-off. And I think that this is where anomalies arise sometimes, that all of the stocks go down together, regardless of the underlying merits. So I think that's interesting. And then at the final slide, at the other end of the risk spectrum, is international public partnerships. Again, fairly steady NAV here. You see it's a jagged line because that's of the regular payment of dividends. And it has been slightly negative, and that's probably really because of bond yields rising, because the discount rate has been going up here. And this trust is very sensitive to bond yields. I think these big infrastructure trusts are seen as bond proxies, and certainly that's an alternative for investors thinking about these. They can just put the money into gilts instead. So when bond yields are rising, that's bad news for the share price, and that's what's happened of late. But I do think it's really interesting. If you look at the steady state percentage of growth here, it's actually very good. Stockbrokers calculate that, and INPP is one of the very best in the sector. And it has an attractive dividend yield of 7.5%. If you buy it now, you will get the next dividend. It goes ex-dividend on the 24th of April. And I wonder whether this is a decent place actually for investors to park some money if they're nervous in the short term about the volatility of equity markets, and you're looking for investments that actually are somewhat away from that growth sector that's been so fantastic for the last few years, but you want to shift some money into something a bit more sensible. This is a possible shelter. I mean, it's hard to say anything's a shelter. Most things are going down at the moment, but I do think this is worth looking at. Okay, that's it, I think, James. I'll hand back to you.
Thank you very much, Andrew. That's great, actually. And I would point out on that thing about the bond yields that for ages the US and UK bond yields have been tracking each other, but the last couple of weeks there's been a big divergence. So US bond yields, 10-year bond yields, are now down below 4%, and that ought to be good for INPP, which has got some kind of overseas assets. But actually, the UK ones are still sticking up there at sort of 4.7ish, something like that. So. Yeah, we'll see.
It's interesting, and just one quick point there. You could argue that if the tariff impact is to slow global economies without introducing too much inflation, then that could encourage more interest rate cuts. And I have seen that actually postulated in the press, so that could be actually quite positive.
We had one question while all that was going on. Why is Gore Street down this week? I think nothing obvious to you.
There's nothing in particular. It does have some US assets, and that could well be the reason. I think as well a little bit of profit taking because it had risen before. So there's nothing I'm aware of to be of concern there.
Me either. Brilliant. Thank you very much, Andrew. Now let's talk to our guests. So we've got this week the Chief Executive of Law Foll. So thank you very much indeed for joining me. As normally with these things, I'm going to hand over to you so you can tell us a bit about the fund, please, and then we'll come to some questions. Please do put questions into the YouTube chat box, and then I will relay them to these people later. So over to you.
Brilliant. Thanks, James. I'm Denis Jackson. I'm the Chief Executive of Law Debenture. Hopefully 4 or 5 minutes of me and then 15 minutes of law and time for Q&A. If we could just move on to the next slide, please. So I'll start with assuming that many of you don't know too much about us, but I know that some of you are quite well versed. But Law Debenture, two distinct but complementary parts. On the left-hand side here, you've got the investment portfolio, 81% of the NAV. That's the bit that James and Laura manage. On the right-hand side, that's the bit that's perhaps a little bit less well known. These are professional services businesses, which are 19% of the net asset value. But very importantly, over the course of the last 10 years, have contributed around a third of the dividend. And it's this combination of these two businesses that we believe, and history tells us, produces material outperformance versus our benchmark over time. Put simply, if we can generate real cash profits in the professional services business to buttress the dividend, then Laura has increased flexibility in portfolio construction. And usually, if you have more choice, you can produce better outcomes. But it's not a one-way street that way. It's incredibly helpful the other way too. When we're competing for business in professional services, it's really very, very helpful to be part of this 135-year-old, 1.2 billion-ish market cap business, which has an independent board. Often we're competing for transactions that can be 30, 50 years in length. So really, really important to be part of such a well-governed and well-capitalized structure. Next slide, please. So just like Laura runs a portfolio of shares, in the professional services businesses, we run a collection of businesses. And at any one time, their performances will be differently. I would love to have a longer time to go into the detail of them. But for the purposes of today, I think it's fair to say all of these businesses have strong elements of repeat revenues. They do have a decent amount of inflation linkage, but we think about 2/3 of their revenues have been repeat on any one year. We have a target here to grow our profits in this business by mid to high single digits. And that's the bit that I've highlighted in red underneath there. So if you look at the last 5 years, we've grown our profits every one of the last 5 years. We've hit that mid to high single digit range. And if we can do that successfully and over time, then that helps our business model to work. So we just go to the next slide, please. As I said earlier, if we've got those real cash profits, that underpins the dividend. The dividend story here, again, we've extrapolated this to a 10-year trend. You can see that we've gone from 16.2p to 33.5p in the last year. So we've more than doubled our dividend over the last 10 years. And while we're very happy with our short-term track record, last year was a decent year. Clearly, when we're investing capital, our shareholders' capital, both in the professional services business and when Laura's investing it, we're looking to produce capital growth in the longer term. So we're most proud of our longer term track record, but equally in a short term basis, pleased with that too. So if I just go to the last slide here for IPS before we hand over to Laura, this is the valuation that we carry IPS on our balance sheet. It's a multiple of EBITDA. It's performed calculated by PwC, so it's third party valuation. That we're given a range and we take the low end of the range from PwC. For the last 3 years, we've been 10.5 times our EBITDA multiple. So really what I'm saying is we're growing this over time because we're growing our earnings over time. It was a 9.2% multiple in 2019. It was 10.8 in 2021, but for the last 3 years, it's 10.5, which isn't a racy multiple. And our goal within the professional services businesses is to grow those sustainably over time. So we are putting cost into those businesses. We're not looking to sell these businesses. We want to grow these businesses in a controlled and sustainable manner, not maximize the profit and sell them out. We're not a private equity company. We don't have a model where we need to churn our portfolio of businesses over time. And all the markets we're in and products we're in, we think we can grow our market share in growing markets. Real cash profits, more choice for Laura. That's what makes us different. So with that, I'll hand over to Laura. Thank you.
The investment objective of this trust is to grow capital and to grow income over time. And the really nice thing about this particular vehicle is that we can focus on growing the capital and treat income as an output. And what I mean by that is that when James and I co-managed this portfolio with James Henderson, when we come in on 1st of January of any year, we pretty much know that 1/3, roughly, of the income for this trust is in the bag. We know that Denis's professional services business, as he said, there's a high degree of recurring revenue, there's a portfolio effect in there. So we can feel relatively certain that we've got that income. And what that allows us to do in managing the portfolio is invest across the breadth of the market and selectively overseas if we think there's a particular opportunity there. But what we're not is confined to the relatively narrow list of UK stocks that pay a high yield. So when you look at, we sit within the UK income sector. Generally within the UK income sector, you will see a lot of similar names in the top 10, the tobacco name, the HSBCs of the world. We can invest beyond those. We can own those if we think they're a good total return, but we can invest beyond that. We can have a greater breadth to our portfolio because of the uniqueness of this particular structure. And I'll go on to talk about more specifically about how that's affected the performance. In terms of how we're managing the portfolio, it is bottom up. It's not thematic. I think it would be pretty challenging actually to be running a thematic portfolio at the moment. And we are very deliberately diversifying the portfolio across sectors and across geographies. So even though it looks like we have 88% in the UK, so you might think, oh, that doesn't look very diverse geographically. In reality, we've only got about 40% exposure to the UK because most of the UK companies that we hold are very international in their exposure. So the likes of GSK, GlaxoSmithKline, global pharmaceutical companies, Shell, etc. So we are very deliberately diversified, and we also have a long list of stocks. There's roughly 150 stocks here. I'm sure I might get a question on tariffs. Again, how do you think about tariffs? How could you possibly insulate from that? I think the only real way, or there are a couple of real ways. The first is diversity, having that diverse list of stocks. And the second, I think equally important, is valuation, which brings us on to the third point here. What is our investment process? It is value driven. We are very deliberately looking for companies that we think are market leading, well managed, ideally have a conservative balance sheet, but we're buying into them at the point where we think the valuation is attractive. And I'll give you a couple of examples of that that we're buying at the moment. And then finally, we do go overseas where we think there's a particular opportunity. We've named Toyota here. Another example I often give is the pharmaceutical sector, where it's a very concentrated global industry. Why confine ourselves to just the likes of GSK and AstraZeneca that are listed here? We can also own and do own the likes of Roche listed in Switzerland, Bristol Myers listed in the States. But we have about 12% overseas at the moment. It's relatively modest in the scheme of the overall portfolio. If we then flick to the next slide, thanks very much. So this is the drivers of performance over the last 5 years. And I think there's a couple of really important themes just to draw out here. The first is that, it's somewhat depressingly as an income fund manager, a lot of these top names would have been very challenging to hold in size in a traditional income fund vehicle. So what I mean by that is the likes of Rolls-Royce here, the top contributor in relative terms over the last 5 years. It does now pay a dividend. It's very recently returned to the dividend list, but it's a yield of less than 1%. It would have been very difficult to hold in size if you were trying to meet the benchmark level of yield in the UK, which is more like 4. Something like Ceres Power is an early stage hydrogen fuel cell generator. It is loss making. It doesn't pay a yield for that reason. It shouldn't, and it won't pay a dividend for at least the next couple of years. Again, would have been challenging. Same with Flutter Entertainment. Same with Applied Materials. I think every time I look at this slide, every time I look at our attributions over a long period of time, this stands out to me, that the breadth that we're allowed to own here, that we have the flexibility to own, really does make a difference over time. It's a similar argument, but effectively the flip side of the same coin is that we don't have to own high dividend yield shares that we don't think are attractive. Again, we can own them if we think that they are attractive. There's no restrictions, but it means that we don't need to hold, you can see here Diageo, we haven't held that. That's been a positive contributor. Volumes there are pretty challenged. There's a relatively high level of debt. We don't need to go there, so we haven't held it. Whereas we have gone overseas, we have the flexibility to do that. Something like Applied Materials in the States, which we sold out, we no longer own it. That's been a good contributor, as has the likes of Caterpillar, big construction machinery, etc. So we've done well. I'm sure everyone on the call will probably be aware that until very recently, US markets have outperformed the likes of the UK. So going flexibly over there has gently helped performance over time. If we then flick on to talk about so this is where we're positioned right now, and I think it's important to address before we go into individual stocks, just where we are from a top-down perspective, which is 88% in the UK. That would be relatively high for this trust versus history. There have been times that it's been in the 70%. 88 would be right at the high end. And we have done that because we think there is a clear value opportunity in the UK at the moment. And what the chart at the bottom of this slide is trying to get across, so this is the PE a valuation metric of the UK versus the MSCI world over a very long period of time. And you can see that there's a very clear dislocation in 2016, no prizes for picking why that's the case. And suddenly the UK derates relative to the rest of the world. And what we need to remember is that, going back to what I was saying a little bit ago, a lot of these companies are global companies. So they're listed on the UK stock market, but they needn't be. And actually, you have seen some companies up and move. But these are global companies. There's no competitive disadvantage to them being in the UK. They just happen to be listed here. And we think that is a value opportunity. Hence, we've been moving gradually. This is not a high turnover portfolio, but gradually towards the UK. What we find quite encouraging, and I know Andrew McHattie talked a bit about corporate activity, we have also seen corporate activity that gives some validation to other people also seeing value in the UK. So what I mean by that is if you look at Law Debenture's results from, say, last year, there was a high level of bid activity in this portfolio. And it wasn't just at the smaller company end. What was really interesting last year was that that bid activity extended all the way up to the FTSE 100. To give a couple of examples, we had bid, it didn't actually go through, but we had bids for the likes of Anglo American. We owned DS Smith, which was a box manufacturer. That did go through. It got acquired by International Paper in the States. That bid activity has continued this calendar year. So we've had a bid for Dowlais, which is an auto parts manufacturer that's been effectively bid for by an American company called American Axle. I could go on, but I think the key point is that you hear a lot of UK fund managers talking about the great valuation opportunity in UK equities, and we all sort of sing from the same hymn sheet there, but we are not the only valuer of these assets. And I think it's really interesting that you're seeing this external interest coming in as well. If we then talk about some stocks, I know everyone's always most interested in stocks, particularly what we're buying. We have bought a couple of fund manager positions this year, Schroders and Aberdeen. So both those are new holdings that we've bought. Similar stories actually in both cases, in that the CFOs of both of those businesses have become the CEO, and both are putting in relatively sizable cost saving programs that we didn't think were being fully appreciated. In the case of Aberdeen, there is also more of a sum of the parts argument in that they own Interactive Investor. Maybe some people listening use Interactive Investor. It's a very popular platform. It's seeing positive net flows. People are often shifting towards Interactive Investor, and we don't think that that is reflected in that Aberdeen valuation. And maybe at some point we might see them pull a lever and you might be able to invest in Interactive Investor on its own. Who knows? Other areas that we've been adding to, the UK consumer actually has it's always on average, you've got to be careful, but the UK consumer on average has a strong balance sheet and has been adding to their savings balance. So we have added to the likes of AB Food, we've also, which is the owner of Primark, it's a conglomerate. We've also added to Kingfisher, which owns B&Q. These are companies that are trading on very low valuations versus their history. In both cases, they're run pretty conservatively, so they have net cash balance sheets before leases. They often have sizable lease balances as well. Going right back to the beginning and thinking, what are we trying to do? We're trying to identify good businesses that are well managed, that are market leading, but at the point where there's some sort of question mark and therefore they're trading at a low valuation. And the likes of ABF and Kingfisher, we think fall within that bucket at the moment. It's not any kind of call on where they're going to trade in the next 6 months. We're investing on a 3 to 5 year time horizon. Again, that's the privilege of running this structure. And this is us saying, AB Foods is a 20-year valuation low. And actually the UK consumer isn't in too bad of a position. That balance sheet isn't too bad. And we have the ability to take that long-term call on that type of stock. Just as importantly, where are we funding it from? It's really important. It's always more fun to talk about where you're buying, but it's really important to think about where you're funding that from. And we have reduced the likes of Flutter, which is a global gambling operator, and the likes of M&S. And just to give you a couple of, it's just how we think about it, because I think it's really important. M&S was one where, we've talked about Kingfisher now, but M&S is one where we bought it in the midst of the pandemic. When Archie Norman, who's the chairman, came in, the shares were about £1 roughly. We were buying quite a sizable position at about £1. They went up to £3.90 roughly, so over 3 times, and we have taken a sizable amount out of that position, and we are using those proceeds to rotate into what we hope will be the next M&S. I hope M&S, by the way, continues to be successful. We still own a 1.5% position in M&S. But we are taking some of those proceeds and rotating into the Kingfishers and the ABFs of the world in the hope of repeating the same. It's all about recycling those proceeds and carrying on what is hopefully a virtuous cycle. And then just not all of the time we will be reducing for that reason. Something like Dowlais we sold after the American Axle merger, or announced merger. It hasn't gone through yet. Just a few words on how the portfolio looks, a couple of things I would say, because we have 150 holdings and this is only the top 15, it doesn't necessarily get across the character of the portfolio because there is a long tail after this, and you can see that the position sizes are relatively modest. That is quite deliberate in the way that we are not trying to take big amounts of risk on individual stocks. Because if you think about the structure of the trust as a whole, one way you could think of it, a way I often describe it to people, is that this trust, you could think of it as having a 20% holding in the IPS business. So the portfolio, in a way, is diversifying away from IPS. So while you might think, oh, these look relatively low position sizes and sort of why have 150 stocks? In a way, that's what we think works for this structure. We are running the portfolio, if you meet me and James and we over a coffee or something, we're saying we're trying not to screw up effectively in running the portfolio. We're trying to allow the strengths of the IPS business to come through. So we're deliberately not taking too much individual stock risk. If we then flick on, so to conclude, and hopefully we'll get some great questions, it's a very volatile environment at the moment. It goes without saying. How do you insulate from that? You have diversity. You pick valuations with a cushion. This is a portfolio that's on roughly 11 times historic earnings, 10 times forward. There are lots of valuation opportunities in the UK market that we think are really attractive. And actually, maybe this is the time. It is uncertain, but the UK doesn't look a particularly bad place to be in a global context right now. And I think it's a really interesting time to be making the case for UK equities, given that the valuation is much lower. Maybe we've got lower commodity prices coming our way. Sterling looks like it's doing okay. We might be heading into a place, and it is uncertain, but we might be heading into a place where UK interest rates can start to come down, inflation coming down. The UK consumer has already been pretty cautious. It has a decent balance sheet. People are nervous, but the valuations are already pretty low in the UK, and I think it's not a bad place to be right now. I'll stop there, and hopefully we'll get some good questions.
Brilliant, thank you both. That's really good. So I do have some questions already, but please do keep them coming. So question for Denis first. So can you tell us what's been driving the increasing profitability? The question is about last year, but maybe you wanted to the general trend of it, please.
Yeah, so as we discussed, portfolio businesses, the ones that did particularly well last year, our corporate trust business did well last year. That likes, so there's different components of that, but generally if capital markets are busy, active, there's a lot of new issuance, that's a good thing for us. And the other thing that's a good thing for us in there is growing business has been our escrow business. Now escrows are where two people want to trade an asset and they need a trusted middleman in the middle of that transaction. Could be for one of these amazing buildings behind me here, could be for an oil tanker, could be for a business, an M&A transaction. So generally, so corporate trust did very well last year. That was on the upside. And then I think within our corporate services businesses, our service process did quite well last year. That thrives off economic activity and capital markets business. Good year for world economy and capital markets last year. And then the third business, which did really well last year, was our Safe Call business, which is our whistleblowing business. Again, this business is one that we've owned since 2007, but realistically, since the dreadful Harvey Weinstein in 2017, legislators around the world have now been putting in place the right frameworks or legislative frameworks to support that business, and there's a mass adoption taking place there. So those are the ones that did particularly well, and I think that if I was to highlight the weak spot, when if you look at our annual report, is our pensions business, and it's weak because the comparators were so strong. 2023 was a unique year for the UK pensions industry following the Liz Truss and Project Quartering budget in late 2022. There was a huge call to action there, and that meant that we had a fantastic 2023. We think we can grow that business 5 to 10% over time, but when it's grown 21%, its comparators were super tough. So portfolio, but those would be the businesses that were either at the top of the charts or the bottom for last year.
Great, thank you very much. Now for Laura, the obvious question that we were expecting. So, what do you think you need to do with the portfolio to respond to tariffs, or do you think it's fine as it is?
I don't expect us to make any wholesale changes, at least in the short term, because I think I genuinely think it would be wrong to do that. There is so much uncertainty at the moment. This is genuinely a situation that no one in living investment memory has been through this type of trade war. It was the same with the pandemic, but lots of people, I have a great benefit of working with James because he's lived through many, many recessions, invested through many recessions. He can, he knows how to sort of guide through that. But a trade war is different, and I think it would be wrong to make snap decisions. Coming back to sort of hammer the point home again, but I think valuations are really important. The UK market is on, rounding a bit, a low teens PE, so private price divided by earnings. I was looking at the S&P this morning after the fall last night, and the S&P is still on 20 times earnings. So I think we'll be getting increasing questions of, are you looking at some of the US names? Do you think now is a more interesting time? I think that there's, without wanting to make a prediction, I think it will be quite a while before we see some attractive valuations in the States that are drawing our eyes away from some of the value names in the UK. And we deliberately positioned ourselves in companies in the UK that are often the market leader, that have good balance sheets, that have, I think what will be increasingly important, experienced management teams that can deal with this the best they can. They won't have lived through this either, but just all these things help at the margin, I think, to provide a cushion against what's going to be what is a genuinely challenging environment.
Great, thank you. There's a question here about interest rates. I think that it's really about when they were rising, what impact did that have, and maybe on both parts of the business. And then if they do come down, how will you benefit? And maybe we could tie that into how the trust approaches gearing and what the borrowing situation is at the moment, please.
Yeah, I'm trying to think. Do you want to start, Dennis, with the borrowing and how it affects your business, and I'll do the portfolio?
Fine. So we've got on from borrowing, we've got about 160 million of long-term fixed rate deals, average interest rate 3.966. We've also got an overdraft available to us, which I think the maximum drawing we've ever had is a couple of million, and we're looking to put in place a revolving credit facility. But as of right now, that would only have an impact if we use the revolving credit facility and interest rates came down in terms of our borrowing cost. Okay, in terms of the gearing level on a day-to-day basis, I'll let Laura answer that. I'll try and answer the question as to how higher or lower interest rates impact the IPS business. The reality is not a lot, unless there's extreme moves. If you've got an extreme move, then that could, if you change interest rates, you change inflation expectations. So within the pensions world, think back to late 2022 and what we had in the UK, that led actually to a lot of work because everyone rushes around and says, do I have the right asset allocation? So interestingly, extreme moves within the pensions world, within markets, leads to increased activity. As to whether you're issuing bonds, I think, again, as long as markets have a level where the markets are 3%, 5%, 7%, corporate treasurers can make decisions. What kills people in the short term is on a week-to-week basis not knowing where things are, right? So I think as long as markets find their level, people will enter into commercial transactions. But these extreme moves in the very short term, they lead to a lot of pens down, and you just get this little hiatus for a period until people see what the new world order looks like.
Okay, let me try and unpick what it means from a portfolio perspective. I mean, when interest rates were going up, what benefited the portfolio were the bank's holdings. That very long period of effectively having zero interest rates was a really challenging environment for the banks. They really struggled to earn their cost of capital. Now, all of a sudden, they are making, mid-teens type returns. The banking sector has really helped the performance of this portfolio. You can see it in the 2024 annual results and the year before as well. If interest rates are now starting to come down, presuming they continue to come down, and we're now, the market's assuming a May rate cut is looking increasingly likely in the UK. What does that mean? Well, the UK economy is pretty much flatlining, with a bit of rounding error. You probably need well, what I think you need is some rate cuts to give people the confidence, or maybe more aptly described as a kicker, to kind of go out and actually spend some of that money that they built up in savings accounts and are being very cautious generally with. So I think, you know, rates coming down would be helpful for some of our more domestic businesses, and we are within Law Debenture in terms of how the portfolio is positioned. We would be overweight domestic UK. We would have roughly 40% exposure to domestic UK, and our FTSE All-Share benchmark would be more like 25. So I think if interest rate cuts do come down, I think that would be beneficial for us, as long as it's not recession. Because clearly, if we are in a recession, you know, even if people are seeing rates come down, they'll probably choose to sit on their hands. So
Yeah,
sorry if that's nuanced, but I think that's just the reality of it.
No, that makes perfect sense. And actually, sort of aligned to that, you've got some small cap exposure within the portfolio. Presumably, that means you're kind of overweight small cap relative to the benchmark.
Yeah.
Is that something you try and deliberately flex, or is that just sort of a normal pattern of where the opportunities are?
Yeah, we deliberately flex it, and you know, there's no getting away from the fact that small and mid cap has been incredibly challenging. In the UK, it's kind of seen if you want to draw a sort of Venn diagrams of challenges, you know, it's had liquidity challenges, it's more domestic, and people, you know, sentiment towards domestic UK is not particularly high. So small cap has been sort of in the middle of what people don't want to own, but there are some very well managed, you know, good quality businesses in there, often with pretty decent, you know, balance sheets at very low valuations. So we have been steadily moving towards those, but I don't want to sort of overplay it. I'm going to round it a bit. You know, this is a portfolio that's 50% odd in the FTSE 100, just over 10% overseas, then a big chunk of mid cap, and sort of high single digit, low double digit type small cap. Because of the size of the trust, it's not going to be ever a particularly small cap portfolio, and I think that's right given the size of it. So we want to flex, but I would say, you know, I don't want to overplay it. It is more at the margin, and there's plenty of opportunity at the large cap end in the UK, I think, as well.
There's a question about AI, but I think that applies to probably both sides of the business. Actually, it's specifically asking Denis, but maybe we'll talk to Denis first. And so, are there opportunities for you to increase the profitability using AI?
We hope so. We believe so, and we're trialing certain things. I think, for example, we run a very large company secretarial business. It appears to us that one of the things that this can help us with is if you're minuting a meeting, it can get you to a very helpful first draft. Now, you still need the human to go from first draft to complete, but we think that we can be focusing, if you like, more on the higher margin end of what we do there. So that's one example. We're trialing it in different places. I think, you know, my chairman gives a very good piece of advice on this stuff. And he uses a cycling race. He says, you want to be in the peloton and you want to be towards the front of the pack. Don't be out of the front and don't be out of the back. So we're trying to be in that peloton, exploring how we can use this intelligently and safely, right? Because we need to scale our business in a controlled manner. And I think it's a bit like, I remember, you know, when the internet first came out, everyone had the internet on their desk, and there were some appalling uses of the internet in offices back in 1995. I think we will look back and say, gosh, I can't believe we gave people access to these tools in such a broad way so early, even though in 10 years' time we're going to be using AI as part of all of our lives. But we just need to do it in a very careful way.
Great, thank you. And for Laura, obviously we had that sort of AI mania last couple of years with NVIDIA and everything else, and you weren't really exposed to that. Maybe this comes back to what you're saying before about maybe opportunities arising in the US, but do you think there's a need for you to get involved now, or are you happy to sit and wait and see how it develops?
So to be honest, the amount of I'm saying things that I'm sure everyone knows, but the amount of capex being spent in that area is really phenomenal, and I feel the returns are not clear yet, especially given where the valuation context is. I think, you know, people need to remember. I remember buying Microsoft at a low double-digit PE, and everyone thinking that Microsoft was a dead company, structurally declining. You know, things can go through very long cycles before you get to the bottom. And so I'm pretty cautious about sort of stepping in to those types of names at the moment. And from a sort of UK context, when we hear companies talk about AI, it's very much on the cost side at the moment. So if you think about the sort of older industries, the telcos, the banks, I think we'll see some pretty big announcements from them using AI to reduce cost. And I think that, in a sort of realistic medium-term timeframe, I think that's the kind of impact that we'll see from a UK market perspective.
Brilliant, thank you. There's a question about the discount, but I'm going to tie that into something else. So obviously, your discount is relatively tight, and there's a lot of consolidation going on within the investment companies sector. So could we just do two questions then? So one is, why do you think the discount's tight, and how do you maintain it? And the other one is, if there was an opportunity, would you look to expand the fund?
So I think the why is, I've been doing this for 7 years and it's still a bit of a mystery, to be honest. Look, we try really hard to perform well, and I think performance has to be the largest part of that. And then some of it is communication. But if our performance was dreadful, it doesn't matter how good our comms are. So it has to be performance, for me, has to be the major driver of that, although it's one of these multiple dimension equations. So, and then the second, I mean, Laura, did you want to answer that before I talk about the second piece? No? Okay. So then on the second half of the question, which is, might there be opportunities? There might be. And we'll be alive to them and explore them, and not only within the investment trust sector. Also, look, we want to grow our IPS businesses organically, but if there are things that we think make commercial sense for us there, we will always explore them, but we prefer organic.
Great. Okay, thank you. There's a question about sustainability. I know you've got BP and Shell and things like that in the portfolio. So how do you view that kind of ESG angle within the way that you approach investing?
To be a balance to the fund. So in a year like the Ukraine year, it was really important that we did have Shell and BP and similar within the portfolio to provide a balance in a year where the energy and materials costs for some of our other companies, so for example the industrial companies that we held, there had to be a balance for that. They had their input costs go up very, very significantly, so thankfully we had BP and Shell on the other side of it. I think we need to view things from an investor perspective and a returns perspective. So for example, I met the Shell CEO very recently. He is coming at their capital allocation with a returns framework in mind and saying, okay, well, I can get a return from my share buyback of this, or I can get a return from capex of this or inorganic of this. And I think that's the right framework to be thinking about from an investor perspective against our FTSE All-Share benchmark. So to be really clear, we are not there are no sector exclusions in this portfolio. Obviously, we want businesses to be managing responsibly in all cases, and we have an excellent governance team at Henderson that meet very regularly with these companies to engage with them, and that's how we think about it.
Brilliant, thank you very much. We've covered actually a lot of the questions, and I know we're kind of running out of time. So, is there anything else you'd like to sort of say to wrap up, Denis?
I would like to wrap up with an invitation for as many of you as possible who own our shares to join us at our AGM next Friday. Lots to talk about. I know Laura and myself and the boards and James would love to meet with you. It's all the details on the website. Vacant roles from those of you who are there at 10:30 onwards, and we'd love to engage with you and talk to you. But crucially, we want you to come and vote and engage with discharge your responsibility as owners of the business with respect to its governance. Yeah,
I'd echo that, definitely. They're very keen for people to vote when they can, and to nag platforms if it's difficult. We had Richard Stone on a couple of weeks ago about the My Share, My Vote thing. It's very important. So thank you very much for your time this morning. Been really interesting, and we will get you on again in a year or two and see how things have been going. But good luck with it all in the meantime. Thank you.
Fantastic. Thank you.
So, we covered an awful lot of ground today. Thank you for sticking with us. We will be back next week talking to the manager of Next Energy Capital, But in the meantime, have a good weekend, and I will see you next Friday.